Welcome to Talk Tickers. Today, we are diving into what might be one of the most brutal earnings reports of the season. We're talking about Hain Celestial, their absolute train wreck of a fourth quarter, and the radical reset they're now forced to attempt.
All right, so let's just get straight to the punchline, shall we? The market's verdict. Wow. It was swift, and it was absolutely brutal. The day they announced these numbers, the stock didn't just dip, it cratered. We're talking a collapse of over 30% in a single day. This wasn't some minor miss, you guys. This was a catastrophic failure to deliver.
And look, you can't even say the market overreacted here. Why? Because the company's own interim CEO, Allison Lewis, basically came right out and said it. She kicked off the call with this incredibly blunt admission, which, just set this really grim tone right from the get-go. She confirmed just how bad things really were. So just how bad was it? Let's break it down. We're going to dissect the anatomy of this miss. The core numbers, well, they really tell the whole story, don't they? Wall Street was looking for a small profit, right? About 4 cents a share. Instead, Hain delivered an adjusted loss of 2 cents. And it wasn't just the bottom line. They missed on revenue too, by more than $8 million. When you miss on both the top and the bottom line like that, it's a huge red flag. It's screaming that there are some deep, deep operational issues going on.
But wait, it gets worse. The real bombshell was kind of buried in the official GAAP numbers, a massive $250 million non-cash impairment charge. So what does that mean? It's basically management throwing up their hands and formally admitting, hey, those companies and brands we bought in the past, yeah, they're not worth nearly what we thought. It's the super painful write-down that took the official net loss to a staggering $273 million for one quarter.
Okay, so the quarter was a complete and utter disaster. No two ways about it. But here's where it gets interesting. Management didn't just come out and say sorry. Nope. They came out swinging with this aggressive new plan they're calling their no regrets turnaround.
At its core, this is a total teardown of the old way of doing things. It's like they're taking this big, clunky, bloated global machine and just dismantling it. They want to replace it with a much leaner, more focused regional model. The whole idea is to get away from the slow, centralized decision-making and instead have nimble, empowered local teams who are actually, close to the customer.
And this new strategy, it's built on 5 key pillars. First, they're going to streamline the portfolio, which, let's be honest, is just corporate speak for cutting a bunch of products that aren't selling. Then they want to accelerate innovation, finally get some strategic pricing in place to deal with inflation, drive productivity, and, get this, seriously upgrade their digital and e-commerce game. It's a lot.
And if you want a perfect example of what streamlining actually looks like in the real world, just look at this. Celestial Seasonings tea. That's their flagship brand, right? Well, they're slashing the number of tea blends from over 90 all the way down to less than 55. I mean, that's exactly what they need to be doing, cutting the complexity to focus their money and their energy on what actually works.
All right, so management's got a plan. Sounds good on paper, but what about the investors? The people who just saw their money get crushed. What are they thinking? Let's switch gears and look at it from their perspective.
The number one thing keeping investors up at night right now is debt, plain and simple. Their leverage ratio, which is just a fancy way of measuring their debt compared to their earnings, is sitting at a really precarious 4.7 times. Now, the good news, if you can call it that, is they got their lenders to raise the limit to 5.5, so that buys them a little bit of breathing room, but their long-term goal is to get below 3.0. Man, they have a long, long way to go.
For investors at this point, it's pretty simple. It's a show me, don't tell me situation. The market needs proof, not just a bunch of promises. So what are the key things everyone's going to be watching? Well, first, any updates on that strategic review they're doing with Goldman Sachs. Second, are they actually seeing sales pick up in their important snack and baby food categories? Third, can they get their profit margins to recover? And finally, are they making real progress selling off assets to pay down that huge mountain of debt?
Okay, let's bring it home. Our final segment, the next call. What does all this chaos mean for the stock from here on out? So, you've got a company in full-blown crisis mode. The stock has been absolutely shattered. The big question for any investor or trader out there is, how in the world do you play this kind of extreme uncertainty? Well, here's one idea, and it's a fascinating one. It's a trade that isn't a bet on whether Hain succeeds or fails. Instead, it's a bet on volatility itself. It's an option strategy called a long strangle.
Basically, you buy two different options at the same time. One that pays off big if the stock skyrockets, and another that pays off big if the stock completely collapses. The thinking here is that Hain is in what you'd call turnaround or die mode. There's no middle ground. If they nail this execution, the stock could have a parabolic move up. But if they fail, well, it could easily be heading towards zero. This trade is designed to make money from a huge explosive move in either direction.
Look, this whole situation is just a perfect illustration of the incredibly high-stakes game Hain Celestial is playing right now. They've slammed the reset button. And for investors, the outcome is probably going to be extreme. We're talking either a spectacular phoenix from the ashes recovery or a final complete collapse. And as always, just a reminder, this is not financial advice.